We've got quite a lot of content, so I'll try and keep it as precise and concise as I can. It's really nice to be presenting back at a normal conference environment again. I'm going to be presenting today along with Laurent Sabatié from Skyline Partners through some of our case studies that I've been involved with, and also Skyline, in context of practical strategies in managing climate-related risks. So we've heard this morning a lot about the science and theory. We're going to try to make it a bit more come alive. And also, in line with that, I was actually asked by the Institute of Risk Management to write a book this year entitled Climate Change Enterprise Risk Management, a practical guide to reaching net zero goals. So quite a challenge, trying to do that top of a job this year, but we've given me a strict deadline and we managed to complete it, and it will be published on the 3rd of December. So just a bit of backdrop, as we know, and I think a lot of conversation this morning was that the world is facing an increasingly volatile and uncertain future. The pandemic, the war in Ukraine. Interestingly, I heard a fact from COP27 that the actual war has led to another 33 million tonnes of greenhouse gases, and rapid changes in the way that work is conducted have introduced an ever faster pace of change in risk and risk management. And actually, enterprise risk management has become a really important, more important role in organisations. These pressures combine with the need for all of us in whatever field, I think we heard this morning, to contribute to a more sustainable future. So just a brief introduction. I actually got involved in climate change risk management 20 years ago. I was actually asked to, through my MBA dissertation, I worked with a major utility company in the UK to develop a hedging strategy for a mild winter. At the time, we talk a lot about average climate change going up, but it's the volatility a lot of companies are obviously focused on, and it was around revenue volatility. So we actually developed a hedging strategy. And that was quite interesting. Certain sectors have been way ahead of the curve, especially the energy sector, have known about climate change, and obviously we're already developing strategies 20 years ago. I've been fortunate in my career to work with some of the leading global insurance and risk companies in the world, including Swiss Re, who are sponsoring the event today, both as a practitioner and as an advisor. I started my own business 2.5 years ago, not a great time in the middle of the pandemic, but I also was asked to chair the Climate Change Committee for the Institute of Risk Management, one or two members here. It's great to see them. But before that, I was a CRO, both in Qatar, quite appropriate, as I'm going out there in a couple of weeks for the World Cup, and London, and managing a Lloyd's syndicate. So I've quite an international experience in risk management. In 2022, I've advised a number of organisations on climate strategy, and also in the area of business development. So sort of joining the dots, looking at solutions. I did 10 COP26 last year. And one of the most interesting areas that I'm working on at the moment is working with Skyline in relation to designing innovative risk financing solutions, particularly for climate-related perils. And Laurent's here to go and run through a couple of case studies. So just brief agenda. What we'll cover is I was asked by the organisers just to give an update on the work we've been doing with the IRM Special Interest Group, which I chair, and also an overview of the book, which I mentioned. We also tried to provide some practical insights to some of the project work that I've been undertaking, primarily within the financial services sector. I'm primarily working with banks and insurance companies. And Laurent will talk more about use of parametric and index solutions and some of the recent case studies that cover certain sectors like the agricultural sector. Depending on time, hopefully we'll have time for questions. So we'll have to be quite quick because we've only got half an hour. Just a little bit backdrop, the IRM activities. So we formed a committee, and actually before that I was involved in the IRM for 25 years. I've worked on a number of special interest groups, and they're really good groups to join. I was part of the innovation group back in 2018 where we wrote the Horizon Scanning Guide. A couple of people here are actually from that committee. It was a groundbreaking publication, I think, at the time, because that concept was quite new in the risk management world, and everybody's using the concept of horizon scanning. The goal of the committee was really to support thought leadership in the industry, and we developed some webinars and surveys. Many of you have attended some of the events and also contributed to the questionnaire surveys. We also developed a Climate Change Matters newsletter, which I found quite helpful, a way of consolidating information, because there's so much new information and new publications, trying to keep abreast of everything is really difficult for risk managers. So that's something that we want to continue to do. I suppose I had a little bit of a break writing the book this year, but we're now looking to, if you like, re-energise and reinvigorate the committee. So we're looking for active new members. So if anybody's interested in joining either the SIG or the committee, then please contact me. So moving on to the book, so it was actually about a year ago the IRM asked me to put forward a proposal to Kogan Page to write a book on climate change, which was accepted, and we were then asked to write the manuscript by end of June, which is quite a tight time frame because it takes a lot of time. I didn't realise the process of writing a book is quite complicated but interesting, and it will be published on the 3rd of December. The main purpose of the book was, and vision, if you like, was to provide practical insights to enable the development and execution of a climate change risk management strategy in any organisation. So I had to be industry agnostic and global, and that was quite a challenge, particularly if you come from a particular sector, although I think financial services, some of the sort of groundbreaking work, we're sort of at the forefront, and that helped. The book is presented, you'll see here, 12 chapters. And so it's quite comprehensive. A couple of chapters on emerging risk management, which is one of my areas of interest. A whole chapter on stress and scenario testing, which we know is a critical tool for risk managers. And on the right-hand side, I've got actually sort of an inverse bow tie. It's an opportunity way of looking at bow ties from an opportunity perspective, looking at the conditions and benefits of embedding climate change into an ERM framework. A lot of focus on the downside of risk and using bow tie for bad scenarios, but bow ties are very helpful actually if you're trying to explain to management about the value and benefits you get from actually achieving goals, which is I think very helpful. And in the context of risk management, it's particularly important to focus on opportunity risk management. The book is likely to form the base of the Climate Change Risk Management Certificate, working closely with Clive Thompson, which is due to be devised and planned and offered by the IRM in 2023. And I'd like to thank Clive actually for the technical director of the IRM for his support and getting the book over the line on time, keeping me on track over the year. And a lot of contributors. I know the whip was out. And also a lot of contribution. Actually had companies like Aon, Swiss Re, S&P, PwC involved in writing case studies, and that's really helped in terms of making it, I think, hopefully valuable but for risk practitioners. And just some of the concepts in the book, just very briefly, it does focus on tools and techniques, developing a risk radar, use of bow tie analysis, stress and scenario testing, and you can see on the left-hand side for resilience, there's a whole range of tools and techniques. And I always felt as a risk practitioner that a lot of these concepts have not been really explained particularly well or understood. So particularly in the area of risk identification, I think we came up with about 20 ways of identifying risks in an organisation, and that's including stakeholder mapping, which actually is probably one of the most powerful strategic tools to help facilitate discussion with key stakeholders. And I've used that actually in training sessions, not only with the risk function, but also strategy teams within banks. And that's a very, very powerful way of looking at all the stakeholders. And we've seen that this morning. It's a critical part of climate change, looking at external stakeholders as well as internal stakeholders. The table on the right is some of the physical case studies from different organisations that actually helped. And just a couple of examples were Southern Water. But interestingly, they helped look at using a bow tie to look at the impact of a drought, and that was before we had a drought. So last summer in the UK and in Europe. So it was quite appropriate that some of these, actually to start to think and plan ahead for some of these events is really quite helpful. Another company, in terms of use of technology, ACS and Previsico are looking at flood risk management. We talk about, how risk management can be developed and adapted. So they've actually built pre-warning systems in apps for their customers, for their insurance arrangements. And that's a win-win. It helps customer communication. It also helps in terms of reducing losses and reducing emissions. So there's a very clear example of how technology used with risk management can build solutions. So a lot of these case studies are in the book. And in the middle, obviously I've covered transition risk as well. There's 2 chapters, one full chapter on how to manage transition risks, obviously in terms of calculating your carbon emissions, to mitigating them. And what's really important, the whole chapter on integration into business processes, as well as covering integration into ERM framework. The book also covers how to integrate, for example, sustainability concepts into existing business processes. And that's particularly important as we look at the value chain discussions we've had this morning, whether it's supplier management, procurement, process, investment, strategy, etc. 2 of the most important chapters in the book, which sort of building blocks, if you like. One is climate strategic positioning and risk appetite integration, and the chapter 3 is actually developing an effective governance framework, which I'll briefly cover. A successful risk management strategy needs to be proportionate. I mean, a lot of focus is on the proportionality in the regulators, so I talk about this a lot, and aligned with and integrated within business processes and activities that I mentioned. It needs to be dynamic, iterative, and responsive to change. What I've found is a lot of companies have, try to meet the regulatory requirements and have a plan in place, but then they sort of move on to the next thing. And actually keeping the plan alive, keeping the strategic plan alive is very important. Obviously, that then links to governance, having a robust governance framework. In terms of strategy itself, companies need to set their level of ambition. And what I've seen in the industry, all across different organisations, some, consciously make a decision to have a passive role in managing risk and affecting change, and others have very proactive approach, take on a leadership role, being a force for good, and having climate change and ESG as part of their core to their overall strategy. And that's quite fundamentally different in approaches. That also then links to the middle diagram, which is really where the role of the risk manager can play a role in articulating the different components of the risk management framework. I used to do risk maturity models and use them when I worked for Marsh, but effectively it's just readapting that to climate change. And they're very similar, the actual criteria, but it's very helpful. I mean, I've talked to a number of CROs, say, do you have a formal risk identification process? And a lot of them say, well, it's a bit ad hoc. You should really have an annual process and work with the business. And I'm quite shocked often when I talk to risk professionals, they don't have formal processes for actually identifying, because all risks like climate and cyber, they're evolving, they're changing all the time. And designing a climate change risk appetite strategy is clearly a critical area. I think a lot of discussion this morning I heard, even when we talked about D&O and underwriters looking at, well, how do they change their risk appetite to manage some of these complex risks. I did advise a Lloyd's syndicate last year in terms of developing a risk appetite strategy, and clearly you need to look at overriding principles, strategic risk metrics, which are setting the net zero targets. Then really what's, I think, much more relevant and important is to look at risk preferences and then key risk indicators. And I've had a lot of discussions around, if you need to be able to measure and monitor your risks, and it's a lot harder than people realise. I'm sure all practitioners here have tried to develop KRIs, but often what I'm finding is that they're actually focused more on KPIs, activity levels. We've actually sent out questionnaires to 40 of our suppliers and we got the feedback. Well, that's not saying anything about the risk. So, what are your key risk indicators? What's your risk appetite and what's your targets? And if you start to think through, and that's where risk practitioners can play a really powerful role. Some examples, obviously, around sustainable investments and seeking to engage with third parties and counterparties that demonstrate they have a clear ESG climate change strategy themselves. So it's that looking at the whole value chain. In terms of governance, I did spend quite a bit of time thinking through the core components. There are about 15 areas that companies should be focusing on in relation to climate change, but also wider governance issues aligned to the 5 core pillars. And the most important areas in terms of climate change governance is clearly around accountability, and that's why the PRA, for example, have specified that there needs to be a senior management function managing the strategy for climate change within an organisation. So it's taken more, I think it's become more relevant because of that issue. Appropriate structures in place. I've seen a lot of very dynamic governance structures being put in place with sub-working groups. For example, looking at product innovation. I mean, that in itself is a subgroup that need time, and you need specialists to look at how you're going to change your products and services as an organisation, feed that back into a central committee. So yeah, it's really important to have the right terms of reference, obviously, for those committees themselves. Another key area which is evolving is the importance of the board to ensure performance against climate-related objectives is reflected, in not only executives but also spread out across employees and across remuneration as well. And I think that's a key area. And that's sort of linked then to culture. This is a culture model that I put together. Try to use graphics to help explain concepts. The analogy there of the bicycle really to reflect the importance of all employees to work collectively with a common purpose and to set values, and secondly to reflect the need for organisations to become more sustainable. So you've got the three core components there: individuals, management and the ERM function itself. And the ERM function can play a really vital role in developing a good risk culture. I think, simple example is training courses, training and development. This year I was actually asked to present a 3-day course to a bank, and we actually presented climate change and ESG strategies to the risk function, to the strategy team and to the investment team, and they're very different and the needs are very different. And I think there's a danger that you can you need to actually tailor courses and bespoke them to the needs of the individual departments. So I'm going to cover very briefly 3 case studies. I'm aware of time here. Last year I worked for about a year on a project with ClimateWise, and this was very much around looking at net zero strategies for the insurance industry as a whole. We developed a portfolio risk assessment tool support from Milliman, working quite closely with Milliman last year. And the idea was to showcase the role of the insurance industry to support transition, amplify the influence on the wider economy and complement other net zero activities. The report entitled Practical Actions Towards Net Zero Underwriting was published last December, and it provided a lot of insights and knowledge, skills and tools needed by the insurance industry. And it was really linked to COP26. I won't go into too much detail given the time, but what I would say is that a lot of the focus is really to adapt the insurer's risk appetite strategy, to ensure more sustainable assets, carbon-friendly companies, as well as reducing capacity and underwriting in fossil fuel-related exposures. But I've also picked up from this morning, there's lots of actual tactical underwriting options available to the industry around improving risk selection. We talked about D&O earlier. I mean, that's a classic example. How do you underwrite that type of business when you know there's increased litigation? So you have to think about risk selection, escalation processes to board, and incentivisation for improved risk management, which Laurent will talk about. A third key area is product innovation, and I think that's the area where the insurance industry but other industries are, I would say, lacking in terms of investment, and that's a key area to help develop low carbon solutions. In terms of very sort of practical project that I was asked to support, this was very much trying to develop an integrated strategic long-term climate action plan for this company and a roadmap. And what I've noticed is a lot of companies, they've done a lot of good work, but it's really consolidating it all into a centralised plan. I broke the problem down. We talked about earlier about breaking problems down. The first area of focus is very much look at regulations, and regulations give very good guidance. The PRA sets out about 22 areas of focus in the SS319 supervisory statement, and aligned to their categorisation of governance, risk management, scenario analysis and disclosures. So that gap analysis was very helpful, but in conjunction with developing scenarios. And interestingly, I used to sort of support, when I was working at AIG with Laurent, actually, we helped build all the scenarios for AIG, and there was a distinction between what I call qualitative scenarios or the RDSs, if you like, realistic disaster scenarios than actually integrated stress tests. And I think people are mixing the two up quite a lot in the industry. So it's very, very helpful to go back to basics and focus on qualitative scenarios, physical, transition, liability risks of facing your risk profile of the organisation, but also key dimensional dynamics different is time horizons. So think about the impact those scenarios will have over different time horizons. So traditional, what was interesting here, we used traditional risk management approaches. There's no point starting from scratch. You've got the infrastructure, you've got risk assessment criteria. So we used existing risk assessment scores, but what we did is we mapped out all physical risk and all transition risk or liability risk on a risk matrix. That is not going to help in terms of doing anything tangible. What it does is prioritizes. It prioritizes, gets people to gain consensus. What are the most important scenarios? And interestingly, we take flood, for example. A lot of companies I've worked with, it's not just a single event they're worried about, it's multiple events in the same year. So you start to think about what is the scenario of most concern. So you're getting into much more of a detailed discussion. And ultimately, when you build a plan, it needs to be updated on an ongoing basis. This year, I've been supporting, this particular plan, looking at supply due diligence, looking at customer communication strategies and developing of KRIs for management reporting. So there's a whole range of areas that we can help as risk practitioners support organisations. And here's just a couple of examples. It's quite helpful to use the PRA sort of definitions of those 4 areas, the types of treatment initiatives. Ownership and prioritisation is also very important, especially when you're presenting back to the board. And also split between what's really regulatory necessary, what's a really strategic initiative for the organisation. And the last, I wanted to highlight this case study as well, because this is a distinction between developing, if you like, qualitative scenarios than if you like, stress tests. And we talked about different climate pathways. So a lot of companies have been asked by regulators, but it's best practice really to think about long-term climate scenarios, looking out to 2030, 2050. On the left-hand side, there's a process, or a 6-stage process for developing any scenario that you can apply across an organisation. And it is important to do the research, it is important to understand the context, but also then look at the different tools available. And there's lots of different tools out there. And why not, again, not use your natural catastrophe modelling outputs for physical risks, work with a global reinsurance broker. You start with your base case. It may not be a base case, you may not have modelled that exposure before, but most likely you have. And then you extrapolate. And we've heard today that, climate change, unfortunately, is going to go up. So your expected losses, your volatility is going to go up over time. So the idea really is to understand the gross and net losses in the short, medium and long term. That is very helpful for stress testing your capital position, but is also very helpful for looking at risk mitigation, contingency planning, and basically future business vulnerabilities. And you can do that for any peril in any geography where you have particularly important or material exposures, I would say, to the organisation. And that's an approach that most companies could adopt using existing infrastructure. The most important thing is really to understand the climate conditions and the assumptions of future changes. For example, in the UK, for example, there's an expectation that losses will increase between 1% and 2% a year. So you could extrapolate that. So it doesn't have to be rocket science as such, but it's using common sense and key assumptions. So with that, I will now pass on to Laurent, who's going to go into talk more about development of use of parametrics, which I think is more the exciting part of the presentation today.
Thank you, Martin. Thank you, Martin. So I'm Laurent Sabatié. So actually, hold on. I'm trying to move to the right slide. Excellent. So hello, everyone. Thank you for having me. Thank you, Martin. So I'm Laurent Sabatié. I'm co-founder and executive director of Skyline Partners, which is a London-based insurtech, which is privately equity funded, and we started in 2017. So we specialize in parametric insurance and geospatial intelligence for event-driven insurance. So my background is insurance. I'm a former colleague of Martin at AIG. I'm a qualified actuary and worked at AXA and AIG, and more recently I was chief actuary of a Lloyd's managing agency. So I'm going to pass this very quickly. So parametric insurance. So just to give a little bit more context for everyone. So this is actually like a different type of insurance, which is, it's not new. It has been around for quite a long time, but as you know, like since maybe a decade has kind of really risen and generated lots of traction because of the new availability of data. You know, through satellite and emergence of new data solutions. But it's an insurance which pays a guaranteed amount when a predefined event occurs. So this is actually like changing the paradigm of insurance, where prior to that, insurance was paying according to a loss adjustment based on a promise made by an insurer. Here, it's actually like transparent and simplifying the process of paying out. And as a result, makes insurance more guaranteed and fast. So you can pay out in days as opposed to months or years, you know, for like natural catastrophic events. So you have fast and certain payouts. It helps, you know, to provide also more transparency for both the clients, the protection buyers, as well as the risk carriers. And it provides also wider cover, which were difficult to insure on a traditional basis. So for instance, you can cover intangible losses, so non-physical damage, business interruption. So you don't need to have a damage to an asset to receive compensation for your supply chain disruption, your increase in operational cost, your resiliency cost. You can go after systemic risks, which are normally, you know, like almost as a boundary of insurability. And you've seen it, you know, of course, with the latest pandemic, but climate change is now becoming almost uninsurable in certain areas of the world. And parametric insurance helps to cover for some of the risk. And of course, emerging risks, where you don't have maybe insurance loss experience, and risk carriers, you know, won't have any appetite because you don't have any, you know, like idea of what will be the probability of making a profitable product. While with parametric insurance, you get access to an index data, and you can objectify this risk and make it, you know, like profitable for both parties. So in terms of application and peril scope, you know, the scope is very wide, and of course, you know, all the climatic risk will be in the main, you know, focus. You know, including natural catastrophes, you know, like tropical cyclones, but also earthquakes, tsunamis, wildfire, but all the other climate risks, you know, like heat stress, flood, excessive rainfall, drought. And in terms of use cases, you know, we've seen an emergence of new use cases, but the main ones being providing emergency funds, you know, like fast payout prior to an event to fund evacuation packages, or post-event, you know, to provide actually like short-term liquidity, to cover gaps, like I discussed earlier, you know, to cover supply chain disruption and non-physical damage, business interruption, which are normally not insured. This can be covered using parametric insurance. To cover the excess retained by corporates, you know, which become more and more important in the context of climate change, where the frequency and intensity are increasing. You know, this excess tend to be increasing as well, so the retention increases. Parametric insurance can help to manage that retention and transfer it out. And interestingly, parametric insurance can be used in the context of climate adaptation. It can help to fund climate adaptation. It can also help to build strategy around, opportunistic strategy around how to differentiate in the context of climate change. How to create maybe new offering, you know, in the context of climate change for your customers. And we see actually much more and more embedding products using parametric insurance to fund this strategy, to provide embedded warranty or, you know, some element of covers, or even, you know, change the business model. And I will illustrate it, you know, with some examples. So for instance, the heat stress product. So we launched a product actually in 2021 in France with, you know, the largest agriculture insurer, Pacifica, and it's carried by SCORE to protect heat stress, against heat stress for the dairy industry. So of course, in the context of climate change, the frequency and intensity of heat stress increases, and we've seen it in the last summer. So actually we paid 75% of the limit in the last summer. 75,000 cows are covered against this risk, and we are protecting against all the intangible losses resulting from heat stress. So loss in yield, increase in operational cost to mitigate these losses, The quality of the milk is impacted because of the fat content and the low level of protein. Everything is impacted. So the bottom line of the industry is impacted. And we are providing, as part of risk management and mitigation strategy with our partner, which is delivering this product, they are using it to differentiate. And we are providing a little help, to protect against this risk. So we are actually launching it now in the UK. It's going to be launched in 2023 with the largest insurer in the UK for agriculture, and we are going global with this one. So second illustration with tropical cyclone. So of course, like in the context of climate change, the frequency and intensity of tropical cyclones is rising, and it's known to everyone here. So we launched this year a product in partnership with Howden Group and Munich Re, distributed via the credit unions of Jamaica, which are providing some short-term loans to the farming industry in Jamaica to help with expenditures, buying poultry, buying inputs at the beginning of the year. When a tropical cyclone occurs, all these businesses and people, vulnerable people, are unable to pay for the loans and are in financial distress. So what we've done is that we have distributed a loan relief as part of the short-term loans. So the credit unions now are able to continue supporting the farming industry even after a tropical cyclone. And we are covering the non-repayment of the loans. And this is distributed via the credit unions. So when a farmer buys a loan, there is a hurricane relief in the loan. And they got a mortgage, like on holiday period, a loan holiday period as part of this. For flood, we have also another illustration here. So actually, like for banks providing, some appliances loan in heavily impacted areas, what we've done is we are working with the banks to provide, again, a way to fund an additional support for populations impacted by flood. They will lose all their appliances, and the loan will be frozen and will be, compensated by this insurance payout to fund additional loans to replace these appliances. Again, it's a way to provide resiliency, distributed via the banks and the loan providers in the region. So this is actually very interesting, to see how parametric insurance can help, the climate adaptation and provide, real life example of, differentiation and making it almost as an opportunity, to provide additional cover and services to your customers. Thank you.
Thank you, Laurent.
Thank you.
Quick whistle tour there. Some of the more exciting developments and product innovation that we've been working on together. This is a summary of key takeaways, I think, from today in terms of risk management integration and the fact that, parametric insurance is growing and will become more important in terms of providing climate adaptation support. Any questions? I know we've run out of time, I think. So